Good evening. My name is Doc Severson. Welcome to the TheoTrade report for Tuesday, July 19th. I'll start out tonight's report looking at the SPX, or the S&P 500 index, and probably one of the best things that I did a few years ago was to kind of strip out all the garbage off my charts and make reading price action on a fractal basis really the foundation of my analysis for trades. So in this case, if I'm swing trading, I'm looking at the monthly chart, the weekly chart, and the daily chart. They're all separated by approximately a factor of 5. So you can get pretty much 90% of what you need just by understanding what the trend is on every time frame. Trend, right? Trend. And understanding the price action, telling you when we have a downtrend moving into an uptrend, and understanding how those reversals kind of start from the smaller time frames and propagate over to the larger time frames. Understanding how all the puzzle pieces fit together has been key. But what I also realized is that there's a kind of a second dimension to all of this, really, if you will, or maybe even a third dimension to this. There's the sense of height to a two-dimensional chart like this that we need to bring in. And it's understanding when the chart goes between what I call range expansion to range contraction, and then range expansion to range contraction, range expansion, range contraction. This is all it does, is it just moves between periods of trending and consolidating, and then trending, and then consolidating, and then trending again. And understanding which way it's going based on the price action. But wouldn't it also be better to know when a trending chart is about to stall and move into a consolidating chart, and vice versa when a consolidating chart is about ready to start trending again? And this is basically why I added this one indicator here, which on thinkorswim I'm calling this a fractal energy indicator, but basically it's just the choppiness index by Dreiss. So you can go ahead and Google that, choppiness index, and you can probably even find the code out there. Certain platforms support it, certain ones do not support it. It's somewhat of an obscure indicator, but basically what it's doing is it's measuring the linearity of a trend. It's measuring the linearity of a trend. What does that mean? Okay, so what this really means then is that when we have a market which is moving in like this, basically when you could put a ruler on it and measure the slope of it like that, we're going to get into what I call an exhaustion period, at which point it's more than likely to move into a consolidation period. Okay, and then when we conversely get a very high level of energy like this is when we would expect to see the opposite of this is another trending period, whether or not it's to the downside, or in this case it's to the upside, right? And then we fall into the same kind of thing here, where we get range contraction moving to range expansion, moving to range contraction, and now we're getting smaller ranges here because the trading range is starting to tighten up, right? So what I found is that this additional level of scrutiny just beyond the price action is very, very useful, because it helps you identify extremes. So extremes, when we saw the sell-off after the British referendum, got us down to an exhaustion level. Then it was a much higher probability trade to be able to sell credit spreads to the downside. Conversely, when we bounced up like this, now we were getting the exact same thing here with an unbelievably exhausted period. So it's no surprise that we're seeing a sideways consolidation up here at this level. No surprise. So this helps understand why we can do that. Now we could use different tools with this. We could use something like the ADX if we wanted to, instead of the chop index. And I know there's a lot of folks out there that like to use the confluence of the Keltner channels and the Bollinger Bands to identify flat, noiseless markets that are basically going sideways. The problem with that one in particular, though, is that it identifies areas like this where there's a great deal of sideways energy built up. Okay, so that's great, but it does not identify the converse of that when we have an exhaustion level, and likely that trend's likely to flame out, at least temporarily. So that's the big key as option traders to be able to take advantage of this market. We're either going to see consolidations where we can trade against that consolidation with some type of non-directional trade, whether it's a time spread, iron condor, iron butterfly, something like that. And then we're going to see the converse of that. We're going to see a big breakout in a trend, which we can take with some type of directional option trade. But from there, we're going to go right back into a consolidation pattern, which we can take advantage of, again, through something like a time spread, condor, some other type of non-directional trade. And then we're going to look for that to break out in some direction again and take advantage of that direction. So this is all that markets are doing. What I'm encouraging people to do is to sort of let go of this concept of overbought and oversold, because I just don't see it happening anymore. In this world of quantitative easing and stimulus money just flowing away out there, these are the types of trends that we're going to see from these things. And so your overbought markets are going to remain overbought for much longer than you're ever going to see. What will stay constant with that, though, is that you're going to see markets rally and move until they're showing exhaustion, and then they're going to consolidate and go sideways, and then they'll rally again and then go sideways. And so this sort of constant oscillation between markets breaking out and trending versus consolidation are the two states of phase that we can really trade something against. So that's kind of a 6-minute primer about how I'm trading these days. I'm looking to identify range contraction periods and setting up non-directional trades against them. And then conversely, I'm looking for these extremes, market extremes, where we're unlikely to see further price action moving in that direction. Again, the operative word here is unlikely. So essentially, we're assigning a probability to those. So it's just a different way to use probability trading, but on a chart instead of an option chain. Now, the big thing that I'm trying to determine these days is what character is likely for the market to display next. Because I think you would agree that there's a big difference between trading a market that's doing something like this versus trading a market that's doing something like this. We have to use a completely different approach. And if you're an option trader, of course, the volatility, the implied volatility, is completely different during those different types of market character. This is what I call volatile and trending. So we have very large ranges of price during the day, and it's trending to the downside, which of course pumps up the implied volatility. And the converse of that is when we get into these quiet and trending, like what we did in 2013, 2014, where it was just kind of a groundhog day. Every single day we'd start up with a little bit of a gap down, and then that got closed, and we eventually would grind our way higher. And day after day after day after day just kind of squeezed the life out of the market until we finally just sort of went sideways as we got up to the top of this in 2014, 2015. So you have to use much different strategies for a market like this versus a market like this. And then in between, kind of, you have a hybrid approach to this. So my biggest question now is, what's next for this? And what I'm looking for, actually, is the type of move that we're seeing right now on the Russell. So if I zoom in on the Russell chart, this is precisely what I want to see if we are going to get one of these types of, kind of Groundhog Day markets to the upside. I'm not going to fight against it. I'm just going to figure out a way to take advantage of something like this. Because a move where we basically go sideways for 1, 2, 3, 4, 5 days in a very tight range, this usually leads to some type of an upside breakout. Usually this sort of flagpole, flag, flagpole, flag, kind of a stair-stepping type of move that we typically see during these Groundhog Day markets, where we get something like this going for an extended period of time, usually longer than most people can believe that it can sustain something like that. But the very act of this is almost like a market running up a mountain and just taking a quick breather every so often. This is precisely what it's doing here. And so we could trade something, very short term against this, something like a calendar spread might be the perfect strategy for something like that. A couple of things to mention on the calendar here. This Thursday, we do have the ECB announcement, and this has the potential to be even bigger than any FOMC announcement, because of course right now this is the first one since the British referendum just got announced a couple weeks ago, right? So this is a big chance for the ECB to sort of like tie things back together and wrestle control from Britain again. So are they going to do something very aggressive? That could be, right? So this is where we have to start watching the ECB announcements. And then, of course, as we get out to next week, so next week on the 27th, we are going to have the FOMC meeting announcement and the results from that. But right now, we are anticipating literally a 0 chance of anything happening. Now, of course, anytime there's a 0% chance of anything happening, this is typically when the FOMC likes to change verbiage on things, and you never know whether that's going to provide uncertainty or more certainty to the market. Of course, the market craves certainty and usually rallies on that type of announcement. What I will leave you with here today is just an intraday chart of Microsoft, and you can see after the earnings announcement, we've gone from about 53 right now up to about 55. So a pretty good little pop to the upside for Microsoft. Right, so that's going to affect just about everything tomorrow. So nice little pop up here to about 55. So not really a breakout at all, but certainly a very market positive event for tomorrow. Again, tomorrow I would expect to see more drifting sideways into the Thursday ECB. That is it for tonight's report. Thanks very much for listening, and we will see you soon.